Trading options is a different animal than trading stocks, and there are tons of misconceptions out there that can be dangerous. But if you know what you're doing, you can actually learn to take advantage of those misconceptions and turn them around to your advantage. Here at SMB Capital in Midtown Manhattan, we see opportunities like this all the time because we study and trade options constantly. So if you're interested in avoiding a really large and possibly costly options trading mistake and would like to learn how professional traders can turn that very misunderstanding into an opportunity for substantial profits, then you should pay close attention to this video. You're going to learn a valuable lesson. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. So you'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investing community. So what I wanted to cover with you today is a question that someone asked me recently about an option strategy known as the long straddle. Before we can explain what a long straddle is, we need to just very quickly review some terms so that those of you who don't know much about options will be able to follow today's lesson. If you already know what options are, just hang in there, this will be quick. So what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of how high the stock is trading. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of his stock he owns at the strike price of that put, again, regardless of how low the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. But if the stock on expiration day is not beyond the strike price of the option, then the seller just pockets the premium that he was given by the buyer. The option, in other words, expires worthless because it was never triggered. Okay, so with that in mind, a long straddle is easy to construct and understand. Basically, you buy a long call option and a long put at the same price. Simple as that. And straddle traders usually buy this long call and long put at options whose strike prices are where the stock's actually trading. So let's take a look at an example of this. Here's a long straddle on Netflix about 2 weeks before it releases its earnings. And this straddle uses options that will expire in 3 days. You'll see the stock is trading at 370, and so the long straddle in this case involves buying a 370 call and a 370 put. The call costs $4.02 and the put costs $3.15. So buying both is a total cash outlay of $717 per share. Since each options contract represents 100 shares of Netflix, the total outlay is $717, which is $7.17 times 100. Now, I'd like you to take a look at the cost of a long straddle 2 weeks later. If you were to buy it at the money, which is the 360 strike now, for both the put and the call, 3 hours before earnings are to be released, you'll see that the price has skyrocketed to $2,543. Why? Well, think about it. Right before earnings, the sellers have a tremendous risk, don't they? A volatile stock like Netflix can easily move dozens of points at once right after an earnings release. So the guy selling you the call option, for example, is taking the chance that he'll sell you an option to buy the stock at 360 when the stock could skyrocket after earnings and be selling for, say, 385 the next morning, but he'd have to sell it to you for 360. So he takes a $25 loss per share, and since an option represents 100 shares of stock, he would take a $2,500 loss. So he's got to charge for that imminent risk because the earnings are coming up in 3 hours. And the same logic for the guy selling the put. He'll have to buy the stock at 360, even if the market hates the earnings releases and sells the stock down to 340. So again, he has to charge for that risk. And the marking up of the options right before earnings for a stock is known as a sharp increase in what is known as the implied volatility of options prices. And you can see that sharp increase is reflected in a greater than 350% increase in the price of that straddle, based purely on the fact that earnings are in 3 hours, not 2 weeks earlier, when the options we were trading were going to expire shortly and way before earnings. This straddle that costs over $2,500, well, that one is exposed to the earnings release because they don't expire for another 2 days after the earnings release. So remember, this video stems from a question I received recently from a viewer who asked, hey, why not just buy a long straddle right before earnings? The stock will, after all, most likely either go up a whole bunch or go down a whole bunch as a result of the market's reaction to that stock's earnings report. So one of the options is bound to make a lot of money, right? Because the call will appreciate if the stock goes up and the put will appreciate if the stock goes down, right? Well, unfortunately, the answer is no. It's not that simple at all because price isn't the only moving part with an options trade. There's also the matter of that implied volatility that I just mentioned. Now, before we get into exactly what happened on this trade, I wanted to mention something, which is that we are currently running a 2-hour free intensive workshop at the moment. So if you'd like to learn 3 real-world option strategies that our traders use, including a simple and effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. So just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open up the free registration page in a new window, so don't worry, you won't lose this video while you're registering. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so back to the long straddle example in Netflix. Let's take a look at what actually happened in this case. Well, the earnings were released after the market closed, and the market mildly disliked the earnings release, and the stock is now trading at 357. So you're probably thinking by that afternoon, the long put, 360 put we bought would be up money, right? I mean, after all, the stock went down, it's trading at 357, so the seller of that put will have to go buy my shares at 360, even though they're only worth 357. So that's a valuable put, isn't it? Well, guess what? The put is only worth $4.55, and the long call is only worth $1.78. I mean, you'd figure the long call would lose value because the stock went down. But the crucial question to ask is, why didn't even the long put appreciate? If you remember, we bought that for $12.80. I mean, the stock went down, right? And yes, it certainly did, but now earnings aren't imminent. Earnings have passed, so the market has already reacted, and therefore the risk of selling one of those put options is way down. Now, the market moving event is in the rear view mirror, and so the sellers of the options don't have to price that much potential movement into the options, which now are expiring in 2 days, incidentally. So the market is only willing to pay $4.55 for those put options versus the $12.80 we had to pay hours before the earnings release. And so that phenomenon, that reduction in pumped up pricing because of an imminent earnings release, is called a volatility crush to professional options traders, because the price gets crushed down to a small number after the big announcement has passed, and traders see how the market has reacted to that announcement. And so in this case, the straddle now depreciated to $633 as the long call got super cheap, and even the long put got super cheap. In other words, they normalized in value because the big unknown is over, and therefore the market can return to normal pricing. So let's compare now. You'll see that 2 weeks before the earnings release, the straddle was worth about the same cost as the straddle right after earnings. It's that straddle right before earnings that is so astronomically priced. And so even though the stock reacted to earnings, the volatility crush of the options that we bought was so severe that even though the market moved in the direction of the put still went down. And so this turned out to be a disaster. We paid $2,543 for the straddle and can only recoup $633 of that the next day. That's a loss of $1,910. And so I'm afraid the answer is a resounding no it's not such a great idea to just go out and buy a straddle right before earnings. As you can see in this example, we got killed doing that because of a combination of the mild market reaction to the earnings release combined with the volatility crush that experienced options traders knew all about in the first place. But let's take this one step further. There are tools available which show the historical tendency of the options market to overestimate the potential move of a stock on earnings and therefore overcharge for the straddle. And so on stocks that fall into that category, sophisticated traders actually take advantage of that tendency by being the guy who sells that straddle. So that is called a short straddle. So in this case, instead of losing $1,910 on the Netflix long straddle, you'd be on the other side of that transaction and being the one gaining $1,910 for selling that straddle. Now at SMB, we'd never actually advocate you're selling that straddle outright. Rather, we would insist that you buy protection for the trade, because even though the historical tendency of the options market is to overestimate the move of this particular stock after earnings, it's possible for the stock to move much more than expected. And so we need to protect against that by buying a long call far out of the money and a long put far out of the money, something like this. So here, instead of buying the long call and long put, we've sold the long call and the long put at the money. But for risk management and margin purposes, we've bought a protective call 40 points above the market for $110 and a protective put 40 points below the market for $106. So think about how we flip the narrative here. We're the ones receiving the straddle premium and instead protecting ourselves with much cheaper protective long options, which are known as wings. And so this whole combination, a short straddle protected by equidistant wings above and below the market price, is known as an iron butterfly. So assuming we've determined that Netflix is a good candidate based on history for an iron butterfly trade around earnings, let's take a look at what would have happened in this case. So as you can see 24 hours later, unlike the long straddle where we got killed, the iron butterfly is up almost $1,700. Now let's really break down why that happened, and we'll do that by showing you what happened when we originally entered the trade and what would happen if we decided to close the trade 24 hours later. So when we originally entered, as you can see, we received a substantial amount of premium for selling the call and the put. In other words, we got that substantial credit for selling the straddle this time instead of buying it. But then we sort of gave some of that back through buying the protective call and put. And when you net it all out, the net is actually a credit of cash into your account of $2,327. Now, let's take a look on the value of those options the next day. And as you can see, because of the volatility crush, we can buy the short call and short put back for a fraction of what we received for them originally the day before, although our protective calls and puts have also shrunk in value. But the fact remains that we can close the whole trade buying back the short options and selling the long options for just $626. So big picture, we brought in $2,327 in cash and paid out to close the trade a total of $626, so that we end up pocketing $1,701, which is the remainder of the original credit that we didn't use to close the trade. So what I'd like you to take away from this video today is two things. Most importantly, if you don't understand the pumping up of options prices right before earnings and the crush in the value of those same options after earnings, then you're in danger of really getting hurt, as you saw in the case of buying the straddle. But with that very same knowledge, you can enter into essentially the opposite trade, taking advantage of the volatility crush and making a killing on an options trade through using your knowledge of selling iron butterflies before earnings. That's the kind of crucial knowledge you get from a good, solid options income educational process. Now, just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that our traders use, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open up the free registration page in a new window, or you can just go ahead over to optionsclass.com to register for this free intensive workshop. Remember, it's unusual for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll experience through this free online workshop. So click the link to sign up now and don't miss it. Now, One more thing I'd like you to do is go ahead and click our subscribe button so you don't miss any of our trading videos produced for the trading and investing community. And while you're at it, please add your feedback in the comments section for what videos you'd like us to produce next, as well as what you found helpful from this video. So from all of us at SMB, trade well.